Been a really strong period for the dollar over the last month or so. Interest rate expectations have been evolving, not necessarily in the near term. There is still a widely held view that the Fed is probably done with its tightening cycle, and if not, there'll probably only be one more interest rate hike in the cycle before we see a period of pause while inflation continues its path back towards the Fed's 2% target. But more over the longer term, that's where the expectations have now started to shift. It's not a case anymore of when will the Fed end its tightening cycle, but when will it resume its easing cycle. Only a few months ago, the market expectations were that we could see some rate cuts from September of this year, with 3, maybe even 4 rate cuts before the end of 2023 and more in 2024. But as you can see here, those expectations have been pushed right back. And the pace of the easing cycle, when it does resume, is expected to now be slower than what was previously expected. That's why we've seen yields at the longer end of the yield curve rising over the course of the last month because of that economic resilience that we've continued to see in the US, the resilience in the labor market as well, which has lifted the dollar against other currencies after a period of performing not so well. Now, one currency that it has performed well against for a prolonged period of time is the yen because of the divergence in monetary policy. The Bank of Japan, while making a couple of tweaks, the most recent one only last month, they've continued to commit to quantitative easing and to yield curve control. Now, because of that divergence, as the Fed's been raising interest rates, the dollars continue to perform well against the Japanese yen. And it's now returned to levels that we saw 2 interventions around late last year, which has stoked more speculation that the Ministry of Finance in Japan may be interested in FX interventions once more. Now, if we take a look at the charts, we can see exactly where those 2 points of intervention were towards the end of last year. The first one came around September time, and you can see that this was just around 146. Now, you can see that the Ministry of Finance intervened around that 146 level. That was on the 22nd of September last year, causing a sharp decline in the dollar-yen pair. It had been speculated about and threatened about for a number of weeks up until that point. And then less than a month later, on the 21st of October, when the dollar yen was trading close to 152, we saw another intervention once more. So now we're trading back around those 146 levels, around the area where that first intervention took place. Now, it's worth noting that the Ministry of Finance and the Bank of Japan have historically said that it's not specific FX levels that they're interested in, more the speed with which they move, which encourages them to consider intervening in the market. And we saw extreme moves towards the back end of last year. We haven't quite seen the same kinds of moves recently, even though that speculation has started to arise once more. As you can see here on the daily chart, we have approached those 146, 146.50 levels once more. And it's no surprise, despite what we've heard from the Ministry of Finance before, that we have started to see momentum wane around these levels. It was actually around 145 that we saw the prices return lower just a couple of months ago. And now around 146 again, you can see the momentum indicators at the bottom did show the price starting to lose momentum once more. Clearly, we were seeing that 146 level, the prior intervention level, having a psychological impact on a trader's mentality around these price levels. And you can see that momentum, even though we didn't make a new high recently, the momentum indicators did make quite significant lower highs, which showed that we were starting to lose a bit of steam in the rally. And you can also see that we've got the other level marked above. Now, 145, 150 are the levels that really stand out here, and they are both just shy of those prior intervention levels. Now, if we take a look at the 4-hour chart here, you can see as well that that loss of momentum that we saw is much more clear. Actually, you could see that it made its most recent high already on low momentum on both the stochastic and the MACD histogram, and to an extent the MACD moving averages as well. What's interesting here is we may have a little double top formation, which could signify that we've had a bit of a bearish breakout over the last 24 hours or so. You can see the double top arrived around 146.50, the neckline around 145. Now, the fact that this also coincides with the 55.89 period simple moving average on that 4-hour chart could be quite interesting as well. We've had a rebound higher towards that 146 level where the previous intervention occurred, which is once again where we're seeing it run into some resistance. We saw it run into support after breaking the neckline around 144.50, the lower end of that 55.89 period simple moving average band. If we do rotate lower from here, that could suggest, having failed to reach those previous highs, that this is a bearish shift, if either temporarily or on a more permanent basis in the dollar-yen pair. So that'll be an interesting one to follow. The interesting thing about double top formations, at least from a textbook level, is that they do give you potential price projections. So the textbooks say that if you've got a double top, then you can take that double top, and it gives you a potential price projection below the neck level, below the neckline as well, to give you an indication as to how much of a corrective move we may potentially see. Of course, the textbooks aren't always accurate, and these things don't always play out as you may or may not expect, but it does give you an indication as to what kind of a bearish breakout or bearish potential breakout we could potentially be facing. I keep saying potentially because ultimately this is technical analysis. It's moving in real time, and plenty of things can affect the price charts beyond these technical levels which we are discussing. But it's quite clear from the charts that we are seeing a little bit of apprehension arrive, and we're seeing apprehension arrive around historical levels where we have seen FX intervention. Now that we're trading around these levels once more, I expect to see a lot more warnings, a lot more threats from the Ministry of Finance, the Bank of Japan, around the prospect of FX intervention. And the thing about those interventions, when they do come, they do not come with specific warning. We tend to hear for weeks, if not months before, that there is scope for intervention, and then it suddenly happens on any particular day. And it's quite clear when it happens because the moves tend to be very sharp. They tend to come very quickly, as well as they did in September and October last year. There's no guarantee that we will see so again, because the level of depreciation that we've seen in the yen has not been quite so stark as it was last year. But clearly, traders are getting a little bit nervous that we could potentially be about to see one once again.